So hello my dear friends, myself CA JOSE Kurian. I'm a practicing chartered accountant and a faculty for your direct tax laws and international taxes for CA, CMA and CS Inter as well as for final levels. And the objective of today's video is quite simple. It is just introduction of controlled foreign corporations. So by making use of this video, I will introduce the concept of CFC to you. All right, so let's make it very simple and short. So starting with the definition of CFC, that is called controlled foreign corporations, it says that CFCs are corporate entities which is incorporated in an overseas low tax jurisdiction. So first of all, CFC is a corporate entity which is incorporated in a low tax jurisdiction. What do you mean by low tax jurisdiction? The place where they charges very low or zero rate of income tax. All right. And that should be controlled directly or indirectly by the residents of a higher tax jurisdiction. Say for example, if you incorporate a foreign company in a low tax jurisdiction, if you are from India and you are incorporating any company in a low tax jurisdiction, that company which is incorporated in the low tax jurisdiction can be called as what? Controlled foreign corporations. Now, as per the global definition, it is a practice of deferring or avoiding taxes of a resident country by non-repatriating income from a company in some other country. So for a better understanding of this definition, we will make use of this particular example. All right. Say for example, I'm an Indian company and dealing in perfumes. All right. I'm an Indian company and it sells perfumes. I want to sell my perfumes globally and to make profit from the globe. So currently I'm dealing only in India, but my vision is to sell my perfumes in the overseas countries and to make profits. But the problem is the investors of this Indian company is not ready to pay any taxes in India. So as you know, if you are an Indian company, then you are an Indian resident. So for all of your global profits, that company is supposed to pay taxes in India. But the investors are not interested to pay any taxes in India. What they're doing? For that, they incorporate a company outside India, which is a 100% subsidiary company. So they are planning to incorporate another foreign company in Cayman Islands. And the speciality of that country, that is Cayman Islands, is they don't charge any income tax. It is called as a tax haven. The rate of income tax in the Cayman Island is 0%. All right. So the Indian company has incorporated a subsidiary company in the country that is called as what? Cayman Islands. Now, this 100% subsidiary company will sell perfumes globally and they will earn profits. Now, there are two companies. Number one, Indian company, the holding company, and number two, the subsidiary company, that is the foreign company. So, this foreign company is earning huge amount of profits by selling the perfumes globally. And they create wealth in the foreign country. They are keep on creating profits or wealth in the foreign country. Now, the question is, the wealth created by the foreign country is of the Indian company, yes or no? Because the foreign company is indirectly the 100% holder of that particular foreign company is an Indian company. So we can say indirectly this Indian company is creating wealth in the foreign country by making use of a foreign company, yes or no? All right. Now the question, if you think from the perspective of Income Tax Act in India, can the department charge income tax on the foreign profits? First of all, the answer is no. Why? Because this profits is not directly created by the Indian company. It is created by a 100% subsidiary company. All right. So income tax department cannot directly charge taxes on the foreign wealth created by the foreign company because the company is in foreign. All right. But if the foreign company distributes dividends to the Indian company, then definitely Income Tax Act or the department can tax on that particular dividend. But the problem is this foreign company will never distribute any dividends. They will keep on creating wealth in the foreign country and they will deposit all the wealth in the foreign country itself. So if they do so, then what happens? Income Tax Department cannot charge any taxes on the foreign wealth indirectly created by the Indian company. Yes or no? This is the concept of CFC. and this foreign company which is incorporated in Cayman Islands is known as what? The controlled foreign corporation, and this is a tax abusive strategy. What do you mean by tax abusive strategy? Simple, that means the investors of Indian company was not ready to pay any taxes for their global profit in India. That's why they incorporated a subsidiary foreign company in a low taxing jurisdiction, and they will create wealth in that particular low taxing jurisdiction, and they are not offering any taxes to the income tax department. And this strategy is said to be controlled foreign corporation strategy. And now let's understand this from an Indian perspective. Presently, there are no statutory provisions in the existing Income Tax Act for directly taxing this foreign wealth. We don't have any direct provision to charge taxes right now. And the CFC rules are there in your direct tax codes. It might come into your Income Tax Act in the near future. Say in the future years, as a part of as an annual budget amendment, they might bring in this direct CFC taxing rules to the Income Tax Act. At present, there is nothing. But we have 3 anti-abusive strategies to counter this tax abuse. Number 1, it is GAAR, that is said to be General Anti-Avoidance Rules. Number 2, we have made place of effective management guidelines to counter this tax abusive strategy. And number 3, there is a concept under section 115 BBD that is called specified foreign company taxation, charging at 15% rate of tax. These 3 things are just anti-abusive strategies to counter this particular tax abusive strategy. And we will study these 3 concepts in detail in our classes. For the time being, I'm just introducing these concepts to you. I hope the concept of controlled foreign corporation is clear. That is a foreign company created to not to offer any taxes in India is said to be CFC, and there are 3 abusive or countermeasures to counter the abusive strategy. So as I've told you, the objective was only to introduce this concept. I hope the CFC concept is clear for you, and thank you for watching the video.